Good afternoon. This is John Gerard, founder of the Institute for Financial Independence and the IFI Advisors Network. Thank you for joining us today. I want to share with you one of our newest unique conversations. And as you know, as a member of the IFI Advisors Network, our job is to make sure that we constantly bring you new ideas, new techniques, new strategies and conversations to present to your clients in order for you to be able to cross-sell and provide more opportunities for them. Now, this new conversation has been probably one of our most effective to date. When I look at my clients, I want them to understand that in my world, there's two types of money out there. There's what we like to call government money, and there's what I like to call usable money. Now, government has a basic role within our tax code, and that is to take our money away from us and redistribute it to allow everybody else to use to make money for everybody else. While we work, it's called the income tax code. They take a certain amount of money that we earn, they redistribute it through taxes, through government programs to make society better and everything else. And that's the role of government. But outside of that, most of the other things in the tax code have created incentives in the tax code in order to follow through on this same theory. If you think about the Great Depression, for example, mortgages were always part of our society, but the only people that actually used mortgages were farmers in order to be able to borrow money to buy their seeds to plant their crops until they grew, and then they could raise that revenue. So they weren't a long-term type of proposition. But in the Great Depression, at a period of time where everyone was afraid of debt, the government, through basic Keynesian theory, knows that in order to get out of the Depression, we have to increase government spending. Well, they did that by creating the Federal Housing Administration, went to the banks and said, make loans on homes to shore up the housing market, but redistribute this government debt to everybody's personal balance sheet rather than the government balance sheet, which is the big argument we're having today, that the government debt is exploding. That was one of our basic tax code incentives. But in 1974, probably the biggest tax code incentive came out after that. In 1974, we came off of a 12-year bear market in the stock market. In the last 6 years prior to 1974, the stock market had a total return of somewhere around 0.0021%. Now think about it. 6 years in the market and your return was less than you're getting today in a money market in 1 year. Well, in order for the government to get people to invest in stocks, bonds, and other products out there, they then created the biggest incentives we've ever seen, and that is retirement accounts, IRAs, 401ks, 403bs, and putting in capital gains taxation on stocks in the marketplace. Now, IRAs, 401ks, they're great retirement accounts, they're great accumulation vehicles, but the problem is, for most financial planners, all talk about accumulating and never really look at the long-term effect of how am I going to get that money out in a tax-efficient manner, and that's where most plans fail. So if you think about it, the government is smarter than us. They're going to give us taxes whenever they can get the most amount of money. If you think about it, when you buy a home, you don't pay taxes when you buy it, you pay taxes when you sell it. Reason is, it's an appreciating asset. But if you parallel that with a car, when you buy a car, you pay taxes when you buy it, not when you sell it. Why? Because it's a depreciating asset. Well, the same thing happens in our tax code in retirement. The government said, take your money and put it in pre-tax, but what are you going to give up for that pre-tax benefit? First off, you're going to give up control of your money, which is one of the foundations of what we talk about in our planning models. First off, you're going to give up control of the taxes you pay, when you pay it, and how much you pay, because the government controls what the tax brackets will be in the future. And just last year, that 5% increase for people making more than $400,000 meant almost an 18% reduction in their retirement accounts, because they increase your taxes by 5%. They imposed the new Obama health care tax on top of that. And due to the Reagan era, taxes are now an after-tax payment. So we just saw an immediate 18% reduction in these assets that people had accumulated because the government controls the most important part of the equation, taxes. Now, in addition to that, the government says if you want to take your money out early, we're going to tax it and penalize it. And if you don't need it when you reach 70 and a half, we're going to tax it and we're going to penalize it even more. So not only is the government controlling the tax on what we put our money in, but more importantly, they're also controlling where we put our money. Because we can't put our IRA in our homes, we can't send our kids to college out of our IRA, we can't buy cars out of our IRAs, we can't take vacations out of our retirement accounts. So the government says in order for you to take your money and maintain that tax break, you must put it in the vehicles we tell you to. Stocks, which means someone else is using it to make money for somebody else. And if there's a nice return, we'll get it. But ultimately, it's not the number one goal. We take risk. They use our money to generate profits for themselves, for the corporate executives, to grow their companies. And at the end of the day, if the markets are favorable, we'll see some return. Bonds, which means someone else is using our money to make money for someone else. And banks, which today are taking that $100,000 CD that's giving us hardly any return and going to the federal treasury and borrowing $900,000 against that 100 and have $1 million of loans out there at 5 or 6%. So as long as our money is in somewhere else where someone else is using it, we can maintain that tax break, whether it's capital gains or anything else. But whenever we want to take our money back into our life to use, the government's going to take taxes out at that stage. So what I'm trying to get my clients to see and the members of the IFI Advisors Network is, in order to really do proper financial planning, you have to make sure the clients understand that as they get older, it's more important in their lives to be able to access money for lump sums, to put in that handicap ramp, to replace the roof that blew off due to the hurricane that just came through, to help my children buy a new house or send kids to college. As people get older, this becomes the most important side of the balance sheet. Where do I go get money that I can get at, regardless of what's happening in the market, volatility, interest rates, inflation, recession, taxes, whatever, that I have usable funds. On that side of the equation, you have bank accounts, CDs, or one of the best strategies that we found with our clients, utilizing old-fashioned whole life insurance as a place to accumulate that cash. Now, we've got a worksheet that we'll walk through that itemizes every investment that you're going to have and itemizing who has control of the investment on this side of the equation, and on this side of the equation, who owns the asset on those usable dollars. We encourage you to review this, contact us here at the IFI Advisors Network, sign up to be one of the members of the IFI Advisors Network, and use this handy tool to be able to really get clients to focus and understand the difference between the types of money they have. It will empower you to cross-sell like you've never seen before. And anytime I do this for a client, they really become amazed when they look and see that the bulk of their money is here and they have very little over here. Then you can engage in a conversation about the future of their life and why it's more important to also have a balance between both sides of the equation, and that gives you the best opportunity for cross-selling. This is John Gerard, founder of the Institute for Financial Independence. Thank you for listening to this video, and please give us a call and contact us if you want any more information how the IFI Advisors Network can help expand your practice and provide you cross-selling opportunities like you've never seen before. Thank you, and have a nice day.